Gold prices have climbed to near 3-week highs as of November 11, 2025. Here are the main drivers and details. The spot price of gold reached about $4,131 and 32 cents per ounce, with December futures around $4,137 and 50 cents per ounce. One major factor, expectations that the Federal Reserve, Fed, will cut interest rates in December. Weaker economic data, job losses in government and retail sectors, soft consumer sentiment, has strengthened that expectation. Another supporting factor, the U.S. government shutdown appears to be nearing resolution. The Senate approved a funding deal that reduces uncertainty in markets and is prompting renewed interest in safe haven assets like gold. Additionally, the U.S. dollar has weakened, which typically supports higher gold prices, since gold is dollar-priced. Technical/outlook notes. Analysts are highlighting that gold could test stronger resistance around $4,160/Oz and possibly higher if the rate cut narrative and weak economic stats continue. Implications for you. If you're watching gold as a hedge, this environment, low interest rates, weaker dollar, economic softness, is favorable for gold demand. But keep in mind, if the Fed pushes back on cuts or economic growth surprises stronger, then gold might pull back. Since you're in Algeria, consider also how local currency conversion or local market premiums affect what you pay/receive in DZD. Oil. Turning to oil, the market is showing mixed signals but with a modest uptick in price as of November 11, 2025. Here are the key details and drivers. Brent crude oil futures settled around $65 and 16 cents per barrel, up $1.10 or 1.72%. West Texas Intermediate crude, WTI, climbed to about $61 and 4 cents per barrel, up $0.91 or 1.51%. Drivers. 1. Sanctions and supply disruptions. U.S. sanctions on Russian oil producers, e.g. Lukoil declaring force majeure on an Iraqi oil field, are constraining certain streams of supply, which supports prices. 2. Optimism about U.S. government reopening. The Senate passing a funding deal is boosting demand expectations. As government workers return, economic activity flows resume. 3. Oversupply worries still present. Despite the above, the market remains cautious because of high production by major producers and risk of surplus next year. For example, OPEC Plus has added 2 million BPD since April, and may add more if voluntary cuts end. 4. Fuel/refinery issues. Some refinery outages and disruptions, including Ukrainian-Russia conflict-related, are influencing refined product markets and helping crude prices in the short term. Outlook/implications. The rally appears moderate and fragile. If supply concerns fade or demand disappoints, oil prices may lose steam. For someone in Algeria or North Africa, local fuel pricing, import costs, and currency conversions can amplify global moves. If you're considering any exposure, directly or indirectly, to oil markets, watch A. OPEC Plus production announcements, B. Major geopolitical disruptions, C. Demand indicators, travel, industrial activity, D. Currency movements, since oil is dollar-denominated.